And I'd like to touch on an earlier question about investing with small sums of money. I'd like to ask both of you, if you were 30 years old again and had your first million in the bank, how would you invest it, assuming you're not a full-time investor, you have another full-time job, you can cover your expenses with other savings for about 18 months, no dependents?
Well, I'll be very simple. Under the conditions you name, I'd probably have it all in a very low-cost index fund, and it'd probably be, might be Vanguard. Somebody I knew was reliable, somebody where the cost was low, and because you postulated that you're not going to become a professional investor, I would recognize the fact that I'm an amateur investor, and I would feel that unless bought during a strong bull market, which this hasn't been, I would feel that that was going to outperform to a degree bonds under current conditions over a long period of time, and then I'd forget it and go back to work. Charlie?
Yeah, it's in the nature of things that you aren't going to have a whole lot of screamingly successful professional investors. You've got a great horde of professionals taking croupiers' profits out of the system, most of them by pretending to be professional investors. And that is in the nature of things too. But if you don't have any rational prospects of being a very skilled professional investor, well, of course you should compromise on some simple thing like an index fund.
And that you will not get that advice from anybody, because nobody gets paid to give you that advice. And so you will have all kinds of people telling you how much better they can do for you than that, and how if you just give them a wrap fee or give them commissions or whatever it may be, that they will do better, but they won't do better. On average, 1,000 other people like you do the same thing. That group of 1,000 will do worse if they listen to the people that make pitches at them. And in the end, why should you expect? I mean, you'll get a perfectly decent return over a 30 or 40-year period by doing what I suggest. And why should you expect more than that when you don't bring anything to the party? The salesman will tell you that you'll get it, but you won't.
Picking stocks or funds, finding that elusive needle that will give you what you think you want in the future, is very difficult. We all know the metaphor of finding a needle in a haystack. It means forget it, it's not worth trying. And I would argue the same thing here. Own the haystack means own the entire U.S. stock market or the entire world stock market. Everybody has different ideas about that. And don't do anything once you get the haystack. No more looking for needles. So Don Quixote had it just right. Buy right means diversify. In an index fund, which is a great way to invest for reasons I've talked about earlier. You at low cost and all that, but you're diversified, so the intricate ins and outs of the market, steel stocks are doing better, or energy stocks are doing better, or healthcare is doing better, or technology is doing better. If you own the whole market, you get your share of all of that. So, that's the buy right, very diversified, and the hold tight is what we've talked a little bit about, and that is, when you get these periods of adversity and fear and greed, don't do anything. Well, we have the miracle of compound interest working for us. And when you invest over 20 years, 30 years, 40 years, 50 years, for today's young people, an investment lifetime is probably 70 years. Their life expectancy today is, if you're 20, it's probably 90. So and then you're going to be investing, after you retire, of course, and presumably that's in your 60s or 70s for some people. And
not you, but
not me. But that curve is just a sweeping curve, and it's the miracle of compounding returns, and it pays off hugely. Albert Einstein called compound interest the greatest financial miracle of all time, or something like that. So take advantage of that, and the only thing that gets you out of it, focus on the long term. Time is your friend. But if you get distracted by the ups and downs, mostly by the downs, people respond much more nervously to downs than they do ebulliently to the ups, although that happens too. But impulse is going to get you in and out of the markets. But think about this. When the market is low, it's low because people like you are really worried. That's a good time to buy stocks, essentially. There aren't any rules for this. And if you're ebullient and feel very wealthy and want to buy stocks, that's at the high. Whereas if you're discouraged and selling at the low and aggressive in buying at the high, your money isn't going to last very long.
Another issue, of course, that's happened in the world of stock picking, where all this money and effort goes into trying to be rational, is that we've had a really horrible thing happen to the investment counseling class. And that is, these index funds have come along and they basically beat everybody. And not only that, the amount by which they beat everybody is roughly the amount of cost of running the operation and making the changes in investments. So you have a whole profession that is basically being paid for accomplishing practically nothing. This is very peculiar. This is not the case with bowel surgery or even the criminal defense bar in the law or something. They have a whole profession where the chosen activity they've selected, they can't do anything. Now, in the old days, the people in the profession always had some of this problem. And they rationalized as follows: we are saving our clients from the insurance salesman and the stockbroker, the standard stockbroker that serves the active trader. And they were saving people from the life insurance salesman and the hustling stockbroker who liked active trading. And I suppose in the sense that the investing class is still saving those people from an even worse fate. But it is very peculiar when a whole profession works so hard and is so admirable, and the members of which we are delighted when they marry into our families, and they just can't do what the profession is really trying to do, which is get better than average results. How is that profession handling this terrible situation as index investing gets more and more popular, and including by a lot of fancy places? Well, I'll give you a very simple answer. They're handling it with denial. They have a horrible problem they can't fix, so they just treat it as non-existent. This is a very stupid way to handle a problem. Now, it may be good when you're thinking about your own death, which you can't fix, and just denial all the way to the end. But in all the practical fields of life, this problem thoroughly understood is half solved, or it's better coped with. So it's wrong to have all these people in just a state of denial and doing what they've always did year after year, and hoping that the world will keep paying them for it, even though an unmanaged index is virtually certain to do better. It's a very serious problem. I don't have any solution for this problem. I do think that index investing, if everybody did it, won't work. But for another considerable period, index investing is going to work better than active stock picking, where you try and know a lot. And of course, the result is almost nobody can outperform an index. Whereas I sit here with my Daily Journal stock, my Berkshire Hathaway stock, my holdings in Lilu's Asian fund, my Costco stock, and of course I'm outperforming everybody. And I'm 95 years old, and I practically never have a transaction. And the answer is I'm right and they're wrong. And that's why it's worked for me and not for them. And the question is, do you want to be more like me or more like them? Now, there's a very confident bunch of people who sell securities who act as though they've got an endless supply of wonderful opportunities. Well, those people are the equivalent of the racetrack tout. They're not even respectable. It's not a good way to live your life, to pretend to know a lot of stuff you don't know and pretend to furnish you a lot of opportunities you're not furnishing. And
My advice to you is avoid those people, but not if you're running a stock brokerage firm. You need them. But it's not the right way to make money.
First, let me differentiate between the active managers, let's call him a stock picker. And for each good stock picker, of course, it's a bad stock picker. There's no way around these things. And then there's asset allocation. How much do you want in stocks and how much do you want in bonds? To me, that is by and large a buy and hold proposition. Don't do something, just stand there, almost no matter what happens, and maybe no matter what happens. For example, even this 50% decline. You ended up with more money 7 years later, from 2007 to 2014, if you just stayed in and just taken your lumps, and it came back if you were in a market index fund. So asset allocation is a little different, but there's one thing that is the same. Please don't let anybody forget this. If you're smart enough to reduce your allocation to stocks and increase your allocation to bonds, somebody else is reducing their allocation to bonds and increasing their allocation to stocks.
The logic is the same.
And the logic is identical. So if the system is roughly, which it is, depending on how you count the Treasury's debt, which is another interesting story, but roughly a 60-40 situation. So you have the total market allocation for the typical investor, and the variations are not huge. Somebody's going to be 100% in equities, which by definition is the best long-term strategy, and yet you may not be able to handle the bumps. Well, let me correct myself. No, 100% equities is not the best long strategy. 100% equities leveraged, 2-to-1, 3-to-1, just so long as you get someone to bail you out at the bottom, and you can pay them back later. This is not an easy thing to do, but we all know those fundamentals. And we all know the allocation for the system is fixed for all of us. So we're trading back and forth with one another, trying to prove we're smarter. And I'd say this about Warren, when he's, as everybody knows, decided to, in the money he's leaving to his widow in a trust, he has directed to be invested 90% in the S&P 500 index fund. Not a bad Vanguard S&P 500 index fund, I should say, because he said it too. And this big bet he has with a hedge fund, which he's winning by a huge amount happily, and they're kind of random events. His bet, his side of the bet, is not that Berkshire will do better than the hedge fund, but that the S&P 500 will do better. So he's a huge supporter, and has been for as long as I've known him, of the index fund. And indeed, when I talked to him about Little Book of Common Sense Investing, I said, I'm going to write in the conclusion. I was just working on the book when I had dinner with him. I guess that would be back in around 2006. And I said, I'd concluded that Benjamin Graham would be an indexer. Do you think that's fair? And because everything changed. Benjamin Graham recanted a lot of, it's hard to find value anymore. There are too many people looking for it. And he said, of course he was an indexer fund. I know because he told me so. And that was good enough for me, so I put it in the book. But so these are the verities of investing, that you're going to depart from this universe of stocks and bonds. If you depart, somebody else does the exact opposite thing. It's a closed universe. And so in that sense, and I love this point, it's a little bit difficult to do without a chart, but the chart is entitled, We're All Indexers. Look at the total stock market. That's what we all own. Now slice about a third of that out, and those are indexers who know the value of indexing. So they own an index fund, and with no trading, arguably no trading. Then look at the other 2/3. Those people own the market index by definition, those stockholders. But they're not satisfied with that. They want to bet against each other, and therefore they lose to the index by the amount of transaction costs they have. None of this is complicated. Warren wrote this great piece, which I edited a little bit, for my book, Little Book of Common Sense, about the Gottrocks family. And they were fine as long as they kept to their own devices. When they started thinking they could beat each other Then they started to do worse. And the costs went up, and the taxes went up. And they did worse and worse until they went back to just buy and hold and don't fight over this with each other. These are verities.
What people don't realize, because they're so mathematically illiterate, is if you make 5% and pay 2 of it to your advisors, you're not losing 40% of your future. You're losing 90%. Because over a long period of time, that little difference causes a 90% disadvantage to you. So it's hugely important for somebody who's a long-term holder not to be paying a big annual toll out of the performance.
Get costs out of the equation. I mentioned to you the magic of compounding returns over the long term, the mathematical magic of it. The problem we have in our society is that magic, on the record, is overwhelmed by the tyranny of compounding long-term costs. And I gave you that example of 7% gross return, net return, 9% gross return, and it's cost you 70% of your capital over your lifetime. Be aware of that.